Okay, so we're gonna start the meeting. I'm so glad to have you here. It's been a long time in coming, just creating a little class on notes. Okay, this is why notes, why now, and how, class 1 of 5. A lot of classes and courses on notes kind of teach you how to broker, they teach you a lot of marketing. But I've had people call me and they say, yeah, but I don't want to know how to do the whole business and broker notes and all of that. I just want to know, how do I buy a note? And so this course, it's not meant to be comprehensive in terms of A to Z for marketing and everything that you would need to know to be in business. I mean, just think of what it takes to be in business for any kind of business. You know, there's multiple areas of expertise that you need to develop: marketing, advertising, promotion, sales, education, fulfillment, billing, I mean, all sorts of things. But what this will do is take you from not knowing what notes are. Well, let's just go down this list. What I want to cover is the philosophies of investing in uncertain times like these. Okay, and in a few minutes, in a few seconds actually, we're going to be going over lots of crazy stuff that we've all been seeing and hearing in the market, and why notes make sense, okay? And how we should be investing and relating to our investments. We're going to be covering the basics of where notes come from and what they are. Now, these are the two things that we will cover in tonight's call. The rest of these objectives will be covered in classes 2 through 5. And if we need extra time or a question and answer session at the end, we'll make extra classes to make sure that everything's covered here. We're going to talk about the different ways to invest in notes and give lots of examples for how. Not tonight, probably next week we'll cover lots of examples. You can be a lender, a private lender. You can be, to invest in notes or paper, you can just simply carry paper on property that you already own. Or you can buy discounted, you can be a discounted note buyer. Okay, 3 different ways that you can invest in notes and be a passive cash flow investor with real estate paper. We're going to talk about how to underwrite both the payer and the property to minimize risk. So you got to know, and in some cases we need to underwrite the seller, but mostly we just need to know how to decide how strong an investment is how likely is that payment stream that you're going to buy, how likely is it to continue coming in as expected? And if something goes wrong, are you going to be happy? We want to make sure you're happy if the note performs, and we want to make sure you're happy if it doesn't. Okay? We're going to talk about changes to the basic note buying fundamentals that have happened fairly recently. I have to teach you the fundamentals of how buying notes has always functioned, and to some degree, of course, they're still in effect. But as things have changed in the overall economy, in my opinion, notes that used to be better, owner-occupied notes used to be better than investor notes, but anymore, that's not always true. And so that's what we're going to talk about: is where were the fundamentals, and now what are the changes that we're seeing in the market based on what's evolving today with people's credit, with people's cash situation, with employment, and all of those things, so that you know how to think and evaluate each deal by yourself, or you can always call me, right? This is another big question. We want to know, how does the simultaneous note sale work in today's market? There's a lot of hype around this, the simultaneous note sale, and a lot of investors that are buying bulk REOs by the fistfuls, and then they want to know how they can turn it around, carry the paper, sell with seller financing, and then just like cash out. Well, it just doesn't work that way. It doesn't mean it doesn't work in some situations, but it doesn't work the way it used to, and we're going to cover that, because that's a really big question that people have, that's very important in people's daily lives if you're an investor. And finally, on the last day, I'm going to give you the step-by-step paperwork trail with downloadable documents to buy a note. So I'm going to give you every document that you're going to need to go through the process of evaluating the note, plus the process of buying it, plus the process of giving instructions to title or escrow or the attorney or whatever, and the things that you're going to need to have in your file when you're all said and done, so that you feel like, I really bought the note and I'm protected and I did it right. Okie dokie. So, the philosophy of investing today. We have a lot of stock market volatility and high unemployment. I mean, let's face it, most investors these days are really freaked out. A lot of people don't know what to do with their money. A lot of them are hiding it in under their mattress or in 1% CDs or in other things that where they're just not making a return because it's safety over return, right? We've got gold. I think today's close was somewhere around this, if I'm not mistaken, 1667. Silver up to 31. These are down a bit, as we know, from a couple in the last couple of months. It's crested. I want to say gold almost got up to 1900, and silver around 40. But what this is saying is people fly to these kinds of things as inflation hedges and as when they're insecure about what's happening in the market, because as currencies are being devalued, commodities like gold and silver that have historically always been considered to be real money are more valuable. Okay, headlines like these. Kaboom, European banks are getting smashed today. Clock ticks towards U.S. government shutdown. I mean, people are like going, what the heck are we supposed to do? Because of all these crazy things. Greek default, possibly Italian default, and others. The official end of the EU. We're looking at drastic U.S. budget slashing without debate. The super committee kind of stuff. We've got headlines talking about war brewing with China. We have printing presses running overtime, over the last, for a long time, but mainly recently, right? Inflation. We've got U.S. stocks are slumping as traders, once again hang on every word coming out of Europe. And this is Agora Financial. I'm going to stop real quick just to take you over to there. And I want to show you things that I want you to kind of tune into. This is, I don't know if you know these people, Agora Financial, agorafinancial.com. I love their little 5 minutes update. If you sign in, it's like a daily newsletter that comes to or magazine that comes to your inbox, and it's just got just 5 minute little snippets of what's going on. I generally like a lot of their commentary. Not always. We don't always see eye to eye, but I like them, and they're very good at disseminating information. There's several newsletters that I subscribe to there. And okay, let's go back here. These are discouraging words again, and this is Agora Financial. Indeed, coming from the chief spokesman for the German Chancellor Angela Merkel. She said today, or just in the last couple of days, dreams that are taking hold again, that with this package, their bailout plans, salvation plans, everything will be solved and everything will be over on Monday, which was today, won't be able to be fulfilled, said Stefan Siebert. Okay, so anything that the stock market's hanging on, it's not very stable right now. There's also this whole Occupy Wall Street thing going on right now, right? Will there be a bank run? I mean, well, in my opinion, the banks aren't lending anyway, right? So on November 5th, supposedly there's this big Guy Fawkes Day, and I don't know if you went over and ever saw if you ever saw this movie, V for Vendetta. I just wanted to bring it up. This was an interesting movie about the whole Guy Fawkes thing and the whole significance of November 5th. And it was a while since I had read it or watched it, like back in probably 2007, 2008, and it didn't really have a lot of significance for me then, but it did this time. So you should go back and if you have a minute, go rent that video. And it's kind of interesting. I think there's a lot of relevance. But the point is, there's a lot of insecurity in terms of like how the banks are really going to fare if who knows? What if it's not like some insecurity, but like what if the Occupy Wall Street really does gain some traction? This whole printing of money and all the bailouts and all this stuff going on and war and all these things, basically the economic policy that we have today equates to an all-out economic warfare on the savers, the middle class, and the baby boomers. So if you've been really intelligent and smart and saved your money and lived frugally, well, you're being punished because the money you've been saving is just being basically ripped out. It's being stolen from you in an invisible way. Inflation is already about 9%. So if you aren't making at least 9% on your money, it's actually disappearing while you sleep. You can't afford not to invest. See, everyone's going, well, I'm too afraid of the risks of this or that. Well, there's a huge risk of not investing because your money is going to disappear on you. It's not if, it's just when and how fast, okay? In fact, I know a good friend of mine who goes, oh, I'm set. He goes, look, I took my inheritance and I bought a free and clear home, and I've got $200,000, left over in savings, bank CDs, and he actually feels like he's set. He feels like he's going to be fine. And I hope he is. But I'm a little worried because I don't trust the economic policy, Washington and Wall Street, to take care of him. Okay? What happens if next year a loaf of bread or a gallon of gas costs $10? The buying power of that $200,000 is greatly reduced. It's not going to outlive him. No way. Okay? He's got to be doing something aggressive just to keep pace, just to tread water. And then there's other questions like, is real estate a good investment, right? I mean, we all know people who've made a killing and then lost everything investing in real estate, or at least thought they were investors, but maybe they were just riding the wave of that whole subprime stuff, the easy money. Have we hit bottom? Who knows? I think in some areas we have, and I think in others we definitely have not. So there's all this uncertainty about, are we really at bottom, and are these really the best prices? I mean, I know lots of investors who have bought property thinking that they're just cleaning up, but basically they've been like collecting seashells on the seashore, just before a tsunami. The water goes out and then leaves all these goodies laying for the pickings, but then the tsunami comes in and wipes everything out. So a lot of investors who bought with that first dip basically have lost up to 50% of their portfolio just by buying cash. How much shadow inventory is there? The banks are controlling a lot of inventory, and they seem to have a lot of flexibility in how they handle the inventory, and they can hold it, they can sell it off in private auctions, they can sell it off to buddies, it's all sorts of things. So there's a lot of uncertainty about how much inventory is out there. I mean, think about it. If tomorrow they took a community that they've been sort of doling out their REOs one at a time, onesie twosie, what if they all of a sudden dumped them all on the market? I don't think they do this, but you can just see that the potential is there. In fact, I was working on a deal in Bakersfield recently where we had a buyer at the table. The investor was willing to offer owner financing, and just before we were getting ready to sign paperwork, the buyer backed out because she goes, "Oh, I'm hearing a rumor that Bank of America is going to release 2,000 REOs next week, so I'll probably get a better deal." So our deal fell apart, and if that was really true, then prices are really going to have a lot of downward pressure in that community until the inventory can be absorbed. We also have to wonder what regulatory brilliance will come out of Wall Street and Washington next. I mean, more of Dodd-Frankenstein stuff. It's like the guys at the top don't have the answers, but then they want to make it really tough for the private sector to come in and provide solutions. And so then we have all this regulatory things that we have to worry about, and it freaks out private investors and makes it harder for them to want to get in the game. And for some, so then I guess maybe they just want you to dump your money into the stock market or into treasuries, places where they can siphon off the wealth more and more. We don't know if rents will continue to go up or will they go down as householders are squeezed between underemployment and rising prices. I mean, yeah, there's a lot of thought that, oh, well, rentals are a good deal, and I agree for the most part, because if there's inflation, rents will go up, and then the rents will keep pace with inflation. But what if there is enough inflation and that people are underemployed and so they have less and less money for housing? Okay, rents might go down. Okay, especially if we've got a ton of rentals, right? And anyway, a lot of sentiment lately, if you look at the polls, are leaning towards renting instead of buying, even if they could afford to buy. They just kind of prefer to rent, let it be someone else's headache, and until they feel more secure about getting into buying. Okay. So, how can we defend ourselves? So, we've seen the great news that's out there. It's really kind of overwhelming. We can see that there's preferential treatment for big banks and large corporations who have access to loads of cheap capital that they control with an increasingly complex regulatory structure. Okay, that's the deal. There's lots of free, easy money, but how many people can actually qualify for a 4% refinance right now, right? It's obvious that we need to look out for ourselves. Yes, we can occupy Wall Street, but my opinion is, I mean, I agree with doing whatever's in your heart to do, but like, why fight? Why not just turn away from it? Why not take the power out of it? Why not just unplug from a system that is increasingly stacked against us and put our money where it strengthens and enriches ourselves, our communities, and our economy? This is a quote by Catherine Austin Fitts, and I love this lady, and I've started consuming her content a bit ago, and she says she keeps reminding all the stuff that's going on. She does like almost a weekly up recap of what's going on in the market. She says, we don't have an economic problem. We have a political problem. And she reminds us that we still have a lot of wealth. It's just that we're letting it be siphoned off by the system. And if we would keep more money in our own communities and out of the grasp of Wall Street and Washington, then basically we would be able to have the benefit of the wealth that we do have. And I'm just going to show you her site because I want you to go over and this is her, the Solari.com. She publishes what she calls the Solari report. And it's $30 a month, and it's worth it. I mean, she she has some technical issues sometimes in terms of like I can't download all of her stuff sometimes in the format that I would like, but this is extremely relevant commentary, and I think it's better to turn off your TV and tune into people like this that are providing very knowledgeable and unplugged sort of guidance for what we have going on right now. So I'm going to refer to her a little bit more later in the presentation. Okay, so just go over here, just check her out, bookmark it, come back for later, okay? Solari.com. Okay, in my opinion, you should go with what you know, and that's why I'm doing this educational course on notes, because I want you to understand and know it because it makes so much sense. And it's not that much different than a real estate transaction. It's very similar in many, many ways, and that will be probably next class. I'll talk to you and I'll show you side by side. Or that might go with class number 4 or 5. I'll have to see. But we're going to side by side show you what happens in a real estate transaction and in a note transaction, and you'll see how similar they really are, and that the note business is not woo-woo, it's not scary, it's not foreign. It's actually just not very well, there's not enough education about it. So congratulations for being here tonight. Most people understand residential real estate, and real estate has always been one of the very best ways to create wealth. I mean, just think about, I don't know about where you live, but in my world, I'm experiencing this whole movement towards community building, local, fresh, organic, slow down, like the slow food movement, simplify, Farmers markets are sprouting up everywhere, pun intended, I guess. Grow your own food, In fact, even our front yard, we sheet mulched the front lawn and put raised garden beds and planted some trees. So like our whole front yard, instead of being a lawn, is edible or medicinal. Which accidentally made us get to know our neighbors because everyone was really interested in what we're doing, and they love sharing food and pointing out things growing on plants. So it's funny, they'll stop and comment on food growing much more than like a beautiful flower blossoming. So you get to know your neighbors. And then actually a lot of communities are trading garden produce and time with each other. In fact, there's 2 or 3 garden exchanges in my community where maybe there's a potluck once a month, and we get together and we just trade. Okay, just bring what you grew too much of and that you don't need, and you trade, and then you get the overages of somebody. Like I got too much oranges, but I don't have any figs, so we trade. Okay, and the time banking thing I wanted to show you too. This is the whole idea of alternative currencies is also becoming very big, and just because I think it's very cool and that I'm involved in helping this get established in my own community, because I believe in the complementary nature of the economics. And I think it's important to catch the people who are falling through the cracks for us to ultimately be able to invest in our own communities in a way that makes us have a sense of abundance regardless of the ridiculous things that are going on in the global economy. Okay, so here's another one, timebanks.org. If you'll just check it out sometime, bookmark that. So anyway, and then invest in things you understand, things you could take control of if you had to. And look for ways to invest in your community and in stable communities across the U.S. This is going from us to the impersonal big banks and big Wall Street, and just, person to person, community to community. Okay, and I think it's a very important trend. The big model is unsustainable. The big banks are unsustainable. We're going to be moving toward local models and models that are just one person dealing with another. Okay, so this is where it's at. The trends definitely support strong rental market. In fact, multifamilies are really popular. I tend to like the things I can really easily control and understand, 1 to 4 units, or I can easily find someone to manage them for me and understand the accounting, etc., etc. But myself included, not everyone wants to be a landlord and deal with tenants, toilets, taxes, trash, that kind of a thing. So the big question is, how can we have investments that are secured by real property we can understand without having to become property managers, and investments that hedge us against further potential declines in the real estate market? Yeah, I want to be secured by real estate, but what if the market's not done softening up yet? So how can we get this nice real estate related investments, but not be exposed to any further declines in one way or another? Okay, in my opinion, notes. That's why I am the Note Queen. Why else would I call myself such a ridiculous name? For some reason, I love owner financing and notes, and I want you to as well. I want you to understand the power and possibility of what notes have to offer. Discounted notes secured by residential real estate that you will have a very small chance of ever owning. Okay, this is great safety, great hedge, simplicity. But if you ever did have the opportunity and you had to foreclose, worst case scenario, right? You would own them at a fraction of the cost you would pay to buy them outright. Your basis would be very low, and we'll expand on this in just a minute. Lending money and or buying discounted notes can be a backdoor way to invest in real estate at rock bottom prices. So even if there is still some softening in real estate prices, there's a small chance of loss because you'd be in at only about 50 cents on the dollar or less. So, for example, if one investor would buy a rental for $50,000 and be happy with his 8% return when it rents for $650, and $650 represents about 1.3% of the purchase price. And just for your information, most people consider that to have a good rental, they want it the rent to be at least 1% of the purchase price. So if someone was happy with just a 1% number there, then they could have paid up to $65,000 for a property that rents for $650. In this case, he only paid $50,000, so the monthly rent represents 1.3% of the purchase price. So it's still a good investment, secured by real estate. He's got his write-offs and whatever depreciation and chance for appreciation. So anyway, so if that investor is happy with his 8% owning the property, why wouldn't you be happy buying a $25,000 first position note secured by that same exact property that earns you 8 to 10% without any of the management or headaches or maintenance or repair surprises? You're making as much or more of a return, and you don't have any of the extra expenses and the extra hassle that comes from owning property, and especially if you're trying to manage it from a distance. And if you did have to foreclose, you'd only be in it for, say, $35,000. So if you bought that note for $25,000, let's say that first investor, they paid $50,000 for the property, they put $25,000 down, and then the owner carried back a $25,000 note, and then you bought that note. So you bought it for $25,000. Let's just pretend. You'll probably pay less, and let's say it cost you $5,000 to foreclose on the property. So now you're in it for $30,000, but now you'd be entitled to that $650 in rent, which would be a much better return, right? So $650 divided by $30,000 is 2.2% of the purchase price. The other guy, he was happy with a 1.3%, right? Worst case scenario, if you get to own this property again, you're going to be making like almost double the return of the original investor. So buying discounted notes secured by a property that you wouldn't mind owning is a great backdoor approach to investing in real estate. Not that we're ever setting anyone up for failure. Number one rule for investing, and in other things, don't be a creep. Okay, so let's just sum it up this way. So if one investor would buy a rental for $50,000 and be happy with his 8% return when it rents for $650, which is 1.3% of the purchase price, then why wouldn't you be happy buying a $25,000 first position note, and then remember that $5,000 in foreclosure fees or something, bringing you in at $30,000, because then you'd make a 13.3% return when you collect that $650 rent, with that 2.2% we mentioned just a second ago. So this guy over here is happy with 8%. Even worst case scenario, you're making 8 to 10% just holding the note. Worst case scenario, your return jumps up to 13.3%. I like those numbers, and it makes me sleep at night, and it makes me not have to work very hard for a really solid investment. But let's just say prices do soften up a bit, or if rents don't quite hold, then you're hedged if you buy the note, because you're only in at half of what the original investor is in at. He's in for $50,000, so a 15% drop in the price or the value of that property means a $7,500 loss for that guy. Okay, if he put in that money, he paid $50. Now it's only worth what would that be, $42,500. He just lost $7,500. For you as the note holder, it would mean that instead of a $20,000 profit, right, $30,000, you get it for $30,000, and then you turn it back around for what the market will pay. You would only have a $12,500 profit instead of a $20,000 profit, right? So instead of being able to turn it around and sell it for 50, you only can sell it for 42.5. But you're looking at a profit. The other guy who owns the property is looking at a loss. You would still be looking at a really nice profit, and that's worst case scenario if you had to foreclose and then resell the property. Or what if rents get competitive because fewer and fewer people have jobs in that community, for instance? Here's the original guy. He's in for $50,000. So $100 drop in rent to $550 might mean his return drops to 5.7% from his anticipated 8% that he bought in the beginning, right? For you, if the note keeps performing, you coast along with your 8 to 10%. Let's just call it 9% return. And if you had to foreclose and you were entitled to receive the $550 rent, your return would increase to 9.5. So the original guy, if rents soften up, he's going to take a big loss to his cash-on-cash return. But you, nothing's going to happen to you. You're just the bank. You're not going to have the ups and downs with the rental. It's not your problem unless you end up owning the property. And in this case, it just increases your return, even in that worst case scenario. So, can you see why notes can be such a great hedge against further declines in the real estate market for values and rents? Okay, so if you're worried of oh, I'm not sure if this is the time to jump into real estate related investments. Well, if you're not sure, then buy either with options and don't put very much money down for your option fee, or buy a discounted note on something you wouldn't mind owning, but if you're going to own it, you'd want to own at a lot lower of a price so that you're okay either way, if the note performs or if it doesn't. Okay, you win no matter which way the cookie crumbles. Now, let's talk about this. Yes, owning the rental itself can give you tax benefits. Like the I don't know, do they still give you the mortgage interest deduction and depreciation and all those things, other losses that you can do tricks with on your tax return? And fair enough to say that it would set you up to gain long term from appreciation, but I'd give it a good long time, like 12 or more years, before you expect to see significant appreciation. It could, like we mentioned a little bit earlier, it can help you hedge against inflation if rents continue to go up. So if inflation goes up and rents keep pace with inflation, then yeah, it can be an inflation hedge, whereas there is a possibility that's why you don't want to get stuck in a super long-term note, because that note payment is not going to go up and keep pace with inflation. So it's all, it could go either way. And that's why maybe you want to diversify and own some cash flowing rental property and some paper secured by the same types of property that you wouldn't mind owning. Okay. And property and paper owner financing and notes, if you haven't already, that's my weekly newsletter where I give lots of tips, articles, special offers, things like that. And I'll go there in just a second. And maybe you want to diversify geographically too. I mean, there are different parts of the country have different employment prospects. There's some cities and states that are particularly strong for employment. We've got Mother Nature that can wreak havoc on whole regions at a time. So I wouldn't want all of my assets in one geographic location, because if some big thing happens in any one area economically or by catastrophe, natural catastrophe, I wouldn't want to be waiting on insurance checks, for everything. So that's why I would want probably to diversify across property and paper and across geographic state lines and such. But I want all of those markets to be something I'm comfortable in and strong markets overall. Also, that lady, the Solari lady, Catherine Austin Fitz, she also just says something that's very significant. If you're going to invest in equities and stocks and stuff, invest in cash flowing companies. Let's say they've got a solid 7%, dividend that they pay every month or whatever. Just invest in those companies that cash flow, would have strong fundamentals, and don't get duped into selling because of market volatility. Just property and paper, This is the newsletter that if you aren't already, please go and sign up for this. It's just on my notequeen.com site / property and paper. Okay. Or if you just hit this like subscribe now button right here, it'll take you right to this page. That's a good place, and tell anyone that you know who you actually care about to sign up for this this kind of stuff. Okay. So just as a reminder, in case you don't know this, we don't have a free market. We have a managed market. It's never been free, not for years, not for decades. Our market is very managed. They've been holding prices of all sorts of things within a range that they feel comfortable with, and if they don't feel like they can manage it with economic policy, we simply do things like go to war and things like that. So these people, they'd like to scare you out of holding the good stuff so that they can buy it at a discount. Like they'll try to scare the gold bugs and the silver bugs and try to make them feel like it's a good time to sell, or they'll raise margin requirements, things like that. And so they actually, I'm not sure they can always control it, but there's definitely times when they don't mind the volatility, because then it scares people out of things where there's real value and real worth and real wealth, and they want you to throw it into something that you feel like is safe, like the dollar, like a treasury, like a CD, like something like that, which is, in my mind, baloney. But so don't be duped, okay? Because they can control the other things, right? And then they can undermine it by devaluing the currency, so you don't realize what they're doing. Okay, so what you need to do is become your own boss, become your own manager, get a self-directed IRA, and find good investments with strong cash flow, and hold on, and then just turn off your freaking TV. Okay, the mainstream media, they're owned by all the big guys, and you can't trust them at all. Okay, I would definitely turn off my TV and just tune in to people like Catherine at the Solari Report, and there's lots of other good things. In fact, on my resource page at Owner Financing Club, there's a lots of blogs and different things that I suggest that you kind of start following and tune into. And then at Property and Paper, I'll be showing you different websites and movie recommendations that I think will be very valuable for you and open your mind to things and how to think about them and how to protect yourself in these times. So good investments, whether it's a real estate investment, a property, or whether it's a note secured by real estate, or whether it's a company with strong cash flow, just buy it, check out the fundamentals, and hold on. Let's get a feel for the players in the market and how everyone fits together. Okay, and I'm assuming that, and please forgive me if this is review for you, but I want to start with someone who really has no idea what a note is, and bring them to the point where they go, oh, I get it, and it's easy. Okay, I want, just in the next few minutes, I expect this whole conversation to be demystified. Okay, here's the principles in the market. We have property sellers, okay, people who own property. We have property buyers, people who want to buy property. And we've got passive investors that want to loan money and just make passive cash flow on all the work that the buyers and sellers are doing. So we have the banks. Okay, they loan money. They're passive cash flow investors. We have private lenders. These are the hard money guys. Most of us are familiar with that. We've got seller carrybacks. These are owners that are willing to become the bank on their own property and carry back paper. And then we've got note buyers who function on the secondary market, and they buy these cash flows as well. Okay, so here are our three principles that we have in the market. Now let's look at the professionals that we have dealing in the market. We've got real estate brokers that are trying to make money between those property sellers and property buyers, making their commissions on those sales. And we know that they're having a tough time because a lot of those deals are having a tough time coming together. And we've got mortgage brokers. They're trying to make money between the buyers and the passive investors. You know, they make their points putting a deal together, a bank loan together, or a hard money loan together, etc. They're having a hard time because they're having to work awfully hard for the deals they can get to come together, and a lot of them just aren't possible. Like I said, we've got that nice cheap capital out there, but nobody can get a hold of it. They've just got all these regulations out there so that only they can basically control where the cheap capital goes because they make it too hard for anyone else to access it. So, and then we've got the little known note brokers, which is what I am and what you may be, or a buyer. And you make money between owner will carry property sellers and passive investors. So if you don't invest yourself, but you find someone who wants to invest in notes, and I'm a little bit of both, and I'm looking for people who want to invest in notes with me or buy notes from me. If they don't want me involved at all, they just want me to bring them deals. But I prefer to stay involved. I think it's a better model for everyone in most instances. But anyway, so then these are the professionals. So we've got the one triangle that's the principals, and we've got the other triangle that's the professionals. And you can see that this is the Jewish, the Star of David. There might be a better name for it, but I love this symbol. I'm not Jewish or anything like that, but I think it's a real symbol of harmony and balance. And I think that if we all understand the variety of ways that each of these principals and professionals can work together, and if we understand each other better, we can create harmony and balance regardless of what's happening in Washington and Wall Street. We don't need the big sources of capital. We can handle this on a community level. Community buyers, community sellers, community passive investors, community professionals. Okay, if we all understand how to work together with understanding owner financing and private notes, we can really create wealth. Remember that Catherine said it's not an economic problem, it's a political problem. It's a problem that all the capital first goes way far away to an impersonal big bank or an impersonal investment firm, and not, in things that people-to-people investments or things in our own communities. Okay, so now taking passive investors, and I'm going to expand on this sector here. We have passive cash flow investors, right? We've got the banks, and we know them, and they're lending money. And then we got the hard money lender, the private lenders, just regular people who want to lend money. These people lend money. Then we've got the property owners that will offer, owner will carry, they'll offer terms, they'll carry paper on their own property. They do not lend money, they lend their equity and or their existing financing if it's attractive. So basically, banks, private lenders, they lend money. Property sellers who become owner will carry, offering terms to the buyer, offer equity. And all of these people, these three entities, these three categories represent the primary mortgage market, the primary loan market, the primary note market. Okay, they're where everything's originated. They're originating paper. Okay, then down here we have discounted note brokers and buyers. This is the secondary market. Okay, and that's why when I say things like, owners who, or real estate professionals who help their sellers put paper together, they need to understand the secondary note market. Okay, this is what I mean. The market where the things that were created on the primary, the origination side, can be sold, usually at a discount, on the secondary market. And as a discounted note broker or buyer, as a buyer of notes, I am on the secondary market. I'm buying from each of these. I could potentially buy bank paper, it's a big deal these days. Buy a non-performing bank paper. Of course, they're selling them for too much, but you could do that, right? I could also buy from a property seller. In fact, this is one of my favorite things to do. One of my primary markets. And then I could also buy from private lenders. Some people get into loans and then they want out of them, or they are doing enough volume that they can sell their notes at a discount because they're making profits and fees in other ways, and they'll originate paper and then just immediately sell it. So I can buy from, on the secondary market as a discounted note buyer, I can buy from any of these three in the primary market. Okay, so this is how you can invest in paper. You can't be a bank. Well, I guess you could be a bank. I don't think you should. Maybe a local credit union. That would be respectable. It's funny. I just want to, that Catherine Austin Fitz on her Solari report, she has this funny recording. The title of it is "Where Would Jesus Bank?" and it's kind of funny. But anyway, it's like take your money out of the big banks and put it in a local bank, community bank, a credit union, things like that. So if you want to invest in paper, you're not going to be a bank. You can own property that you're going to offer terms on. You're going to loan your equity on. You can be a private lender. You can go to some hard money lender, broker in your neighborhood and say, look, I've got money. Next time you have a deal, I'll fund it. And then that broker goes, great, because then I'll make the points, right? So you can do that. Or you can buy on the secondary market. You can be a discounted note buyer. Okay, and there's advantages depending on what situation you're in, to each one of these three different ways that you can invest in paper, invest in notes. Okay, now let's see where the note business come from. Who's your mama? Okay. And so here, we're going to go over here to, there's some videos that are up on Owner Financing Club that just, I've already explained this so many times. We're going to stop and I'm just going to let you watch this video. Okay? And they're not too long. And I realize we're actually going to go over a little bit. So sorry about that, but hope you can hang with me. Hi, this is Dawn. One of the first things that I want to cover is a couple of terms that sometimes throw people in a tizzy and they think they're all mysterious and hard to understand. One of them is owner financing or seller financing. Oh my God, what is that? Even a lot of people who, let's say, have been a real estate agent for a long time have a hard time understanding really what seller financing is. It sounds so scary and woo-woo and so out there. And I want to show you that it's really not. I want to bring the note business and owner financing together on the same plate for you and show you that dance between property and paper that I like. I see lots of people teaching owner financing and seller financing techniques as a way of buying and selling property. And I see people teaching about the note business and what the note business is. Few people bring these together. Once you understand these steps, the steps to this dance, I'm talking about the dance between property and paper, real estate and real estate notes, then you have so much flexibility. You will see so many options that you didn't even think of. It's just amazing. So, okay. So let's take a really simple example, and I apologize for those of you that this is going to be extreme review for some of you. You might want to fast forward or whatever, but what I want to do is take someone who knows absolutely nothing and show them really how simple all of this is, okay? So we're going to start super basic with a little single family house, and we're going to say that this property is worth $100,000, or it's being listed for $100,000 by the seller. Okay, and for the purposes of this example, we're going to pretend that the seller owns this property free and clear, meaning they don't have any mortgage against it. They don't owe anything. They either paid cash for it, inherited it, or they paid off the loan a long time ago. Okay, so they have 100% equity. At this point, they've got $100,000 of equity in this property. Okay, now along comes a buyer who goes, I want that. I want to buy that house to live in for my family, and I've been saving, and I have, hopefully they have saved up at least 10% of the down payment. That's a really good, solid, acceptable number in most underwriting circles. Remember when the banks used to ask for 20% though? Okay, so the buyer says, I've been saving my money and I've saved up 10%. What's 10% of 100,000? 10,000. So there's, Mr. Seller, I'd be willing to give you my down payment of $10,000 that I've been saving. But I don't have 100, but I've got 10. But tell you what, I'm going to run over to the bank. This really, Let's pretend like it's a really solid and fancy structure that we can all trust and count on. Right? Okay. Okay, so they say, can I get a loan? I need $90,000 more. The bank, you know, within a couple of days, maybe a week at the outside, say, yeah, no problem. Or is it a year or two? I can't remember. But eventually, if the buyer has good enough credit and the property does appraise, and they say, yes, it's worth $100,000 or more in our opinion, we think you're a good risk. So yes, we are going to lend you the money. They make a loan of money, and this is $90,000, so that the buyer can then turn around, take this money, and give it to the seller, who then has their $90,000 from the bank, and they have their $10,000 from the down payment from the buyer, and they're good. They got their $100,000, and the seller's happy. But how do we make the bank happy? They've just lent the buyer $90,000. What are they going to want in return? Well, they're going to ask the buyer to sign a note. They're going to want two things: a note, a promissory note, and a security instrument, which will either be a mortgage or a deed of trust, a trust deed, depending on what state that you're living in. So here's what the bank says: I gave you this, what are you going to do for me? Okay, the buyer then gives the bank, how can we do this? They give them a note, and they give them a security instrument. The house is the security for the loan, the collateral. The bank gets a deed of trust or a mortgage. Okay? So the note, what does the note say? The note says, okay, bank, you loaned me $90,000. You gave me an interest rate of 6%, and you set the term at 30 years, so you're giving me 360 months to pay off this loan, and that gives me a monthly payment of $539.60. Buyer says, I promise to you, promissory note, I promise to pay you $539.60 for the next 360 months, the next 30 years. I promise to pay you back the money that you lent me. And the bank says, that's nice. It's nice that you promise, but if you break your promise and you don't pay us the money, we want a way to get our money back. We want security for our investment. Okay, so if you don't pay us according to the terms of the promissory note, we are going to take your property that you've pledged as collateral for this note. So we all know what that looks like, right? Foreclosure. They just say, you didn't pay, we're taking the property so we can sell it and get as much of our $90,000 back as we can out of it. Okay, so that is, and I'm going to break this right down the middle. That's mostly what we know and are comfortable with in terms of real estate transactions. So what's over here? Owner financing. How does owner financing work? I mean, think about it. We say that the bank is in the lending business. They loan money, which is true. But couldn't we also say that they're in the note business? What did they ask for and what are they holding? They're holding a note. They're receiving payments on the terms of a promissory note. So really, just think of the bank as being in the note business. Yeah, they lent money, but what they're holding is a note and a deed of trust. Okay? Just think about that. Banks are in the note business. Okay. Over here, the buyer says... Okay, so then where's part two? Part two, click to watch video. Here we go. Over here, the buyer says, in this scenario, The buyer says, look, either to the seller, I want your property, I've saved up $10,000, will you offer terms? Will you provide the financing? Will you carry paper for me? What's paper? This note. The note's actually written on a piece of paper, right? You sign it, gets notarized, whatever. Will you carry for me? Either I don't want to go to the bank and get a loan, or I can't. You know, my credit score is not good, I had a bankruptcy, I had a foreclosure, whatever. I can't get a loan right now, but I have enough money to buy this house. So, or the seller says, yes, I will. So the seller actually steps over here and okay, they become the bank. Okay, this is kind of weird, but the seller said when they offered seller financing, they become the bank on property they already own. Do they actually go over and get a loan from the bank and give it to the buyer since the buyer can't get their own? No, that's not what happens. The seller becomes the bank. They morph. This is seller bank, okay? The seller becomes the bank on their own property. And so the buyer says, okay, I'm going to give you my down payment of $10,000. And I'm hoping that you, seller bank, are going to lend me your equity. You have $100,000 of equity in your property. I gave you $10,000 in a down payment. Now you have, I really owe you $90,000 more, but will you lend me your equity over time? And the seller says, okay, I'll do that. So the seller, who's acting as the bank on their own property, gives the buyer, loans them their equity. The bank over here loans actual money, or I don't know, little bits and bytes and electronic data, right? That's really what it is. But they lend money. Over here, the seller, this is the same person, right? Seller, owner of the property, seller as the bank. The seller loans equity. How are we going to treat this? So now what do we do? How do they loan equity? And what do we, oh, okay, well, let's do the numbers. $90,000 of equity, and the seller says, look, I'll carry this for you at 6% interest. I'll carry for 30 years. I'll give you 360 months to pay this back to me, and that will be a monthly payment of $539.60. Same, right? So in exchange for that, does the seller just go, hey, no biggie, I trust you to pay me? No. What are they going to want? If I do this for you, if I lend you my equity, and what I want is the same as what the bank wanted. I want a note. And what does the note say? The note says, I, the buyer, promise to pay you, the seller, $539.60 for the next 360 months. But if I don't, you can take my property. Okay? And you can foreclose on me just like the bank would. So here we have seller lends equity, bank lends money. Note is exactly the same. This is an institutional note. This is institutional paper. This is a private loan, private terms. This is private paper. Okay, but they're exactly the same in so many regards. Okay, when a bank or person makes a loan, here's the things that go on. We've got a promissory note like we just watched in the video. We've got a security instrument, the deed or mortgage. Here's the other things. We've got title insurance, right? There's an owner's policy that protects the new owner in the chain of title, and usually there's a lender policy so that the lender is secured in, has insurance to be secured in first position. There's hazard insurance that secures the lien holder first, the mortgagee first. And there's a credit check. There's an ability to pay. And there's a valuation of the property. Okay. We don't need to make a story out of it right now, but just to show you that here's all the things that happen in a cash to new loan deal that also happen. Ideally, they all happen, including that nice credit check and ability to pay, all happen in the owner will carry scenario, the seller carryback scenario, and all of these issues, and we'll expand upon this in a later class, but these are all the things that you're going to need to look at when you're buying a note. Okay. You can see that owner financing is pregnant. It's pregnant and gives birth to what we traditionally consider the note business. The note business, as it's been sold on late night infomercials and all sorts of things, the note business mainly refers to that owner will carry private note business. Okay, it's not usually referring to buying discounted non-performing bank paper or buying private lender paper, hard money lender paper. It's usually referring to the secondary market of buying the paper that has been created when an owner carries back paper, offers terms to the buyer. Okay, the note and loan business, there's some part of me that doesn't want to call it the same, like a lending equity and lending money, the same thing, because that's where we get into the regulatory hoo-yah with Dodd-Frank and all them wanting to control everything. But here, I'm going to do it anyway, just so that you understand that notes and loans are kind of the same thing. We've got the commercial sector. It's usually large institutions. We have usually very standard loan rates and terms, right? Everyone thinks in terms of amortized over 30 years. Their paper can be performing or non-performing, and they often sell their notes or their loans back and forth to each other, right? The private note business, it's usually individuals, and increasingly so. In fact, it used to be that there were a handful of large institutions that just focused on buying private seller carryback paper, but most of those have gone belly up and went the way of things back when the mortgage-backed securities market disappeared. And there's a bit of a conversation about this on that chapter in my book that talks about my interview with Clint Hinman. I think it's the simultaneous note chapter. When it's a private note, it's highly customizable. It doesn't have to be, amortized over 30. In fact, I would highly suggest that you don't do such a thing because it decreases the value of the note on the secondary market. Those note buyers don't want to buy a note payment that's coming in 30 years from now. It's not worth very much, by the time you count in inflation. The private paper can be performing or non-performing, meaning, the payments are coming in or they're not. And they can sell their paper if they structure it well. The big difference between the commercial side and the private side is the commercial side, they know they can sell their paper. In fact, they only create their paper if they think they can sell it generally. On the private side, people create paper and sometimes they don't even know there's a secondary market. And even if they know, they often don't know what people will pay for it. When Bank of America or Chase or any of those too big to fail banks makes a loan, do they just hope that there's going to be a secondary market that they'll be able to sell the loan to? No. First, they see what Fannie and Freddie will buy, and then they go forward and say, here's what we'll loan. Here's the paper we'll create, because we know this is what we can buy. When owner will carry sellers agree to carry back paper or offer terms to their buyer to get their property sold for top dollar, which is a great idea, should they just hope that there's going to be a secondary market that they'll be able to sell their note to? No. In my opinion, and it's one of the greatest emphasis of my work in getting out in the retail market, is these private sellers and the real estate agents that work with them. They should first find out, what are the private note buyers buying? Okay, they're the equivalent of Fannie and Freddie, the secondary mortgage market, okay, in the private sector. So if that's why I created my whole consulting model, because these sellers and buyers who don't do a lot of this, they maybe have 1 or 3 or 5 properties they're ever going to carry paper on in their entire life. They don't have an underwriting department, and they don't understand that they can sell their note, or what makes their note more valuable. And that's where we as note buyers come in. If we can get to those people when they're creating the paper, we'll have a much better product that we can buy at a price that makes a lot more sense to those note holders that may want to sell. Okay, first they're property owners, then they become note holders, and then they become note sellers if they want to cash out. Okay, so that's the basic. Now I'm going to go to questions. Anyway, thank you so much for being a part of it. I know you've been muted out for most of it. And if you have any questions during the week, our next one is going to be same bat channel, same bat time next week. Please email me questions, and I'll be sure to answer them with the next call or beforehand even. So anyway, thanks again. Thanks for being part of Why Notes, Why Now, and How, the end of Class 1 of 5. See you next week for Class 2. Have a great week. Bye-bye.